And thank you everyone for joining us this evening for the Quarterly Connect session. I'm going to keep my comments brief as we want to make sure that we leave ample time for Q&A towards the tail end. Just a quick update. The team has, over the last 4.5 years, delivered solid results, strong results, as many of you are, if not all of you are aware, as a consequence of which you have reposed your confidence and trust in the team. That's helped us now grow to a AUM asset base of 42,000 crores, of which very glad to say that the domestic AUM has now grown to 10,000 crores. First time crossed the 10,000 crore figure. We can move on to the next slide. So what's helped achieve the performance over the last few years remains what I've always mentioned, and won't go into too much depth, as for with most of you I must have covered this already. It's been delivered on the back of our strong, focused investment culture, what we refer to as performance first culture, meaning that the sole driver for all of us on the team is to strive to achieve the highest return for our client portfolios compared to anyone else in the peer group. And it's founded upon these 4 pillars: team, philosophy, process, and portfolio construction, which I'm sure we've discussed earlier. I would not go into the details of each one of this, except for just highlight that the team, since we last spoke, has been further strengthened. We continue to meet with very strong candidates. It's an ongoing process, and when we do find someone whom we believe would be a great addition to the team, we bring them on board. So it's a extremely well-resourced team. It was an extremely well-resourced team to begin with, and even better resourced now with additions that we made in the recent months. Go to the next slide, please, now, and move to the macro backdrop for India. Before going on any macro discussion, which would be part of a lot of our Q&A today as well, I want to remind again that the most compelling reason to invest, which make Indian market far more exciting, is the strong alpha generation opportunity, the inefficiency of the market compared to other markets. In general, emerging markets tend to be more inefficient than developed markets. For example, in the US, as this slide shows, after fees, the average manager underperforms by a couple of percentage points or so. Whereas in India, at least this is as of pre-COVID published study in Wall Street Journal, shows that India offers the opportunity, at least over the prior 10 years, the average manager in India post fees still generated 2 to 3 percentage points of net alpha. So that inefficiency in the market provides the opportunity for extra returns, which is an important element of the total return. I think the market return should be expected to be in the similar range around the world, 5 to 6%, maybe the lower end of that range for developed markets like US, higher end of the range for emerging markets like India, which one can argue is a small increment for the risk associated. So the extraordinary juice lies in the alpha opportunity, the opportunity for outperformance, which our team has captured very well. We go to the next slide now and talk more about just what's happening. The longer term backdrop, as you know, would have heard us say before, that equity markets around the world tend to, and the empirical evidence supports it, that they tend to deliver returns in line with nominal GDP growth of the economy. So if you look at the US, Europe, and so on, over many decades, long periods, their returns are similar to nominal GDP growth rate plus a small fraction for the dividend yield. And in India also, it's been like that. And there's logical underpinning to it, which I'm sure we have discussed before. Otherwise, happy to answer in Q&A. The growth over the last 25, 30 years has been 11 to 12% in nominal GDP growth rate on the back of similar corporate earnings growth. Then the return from the market has also been in the same 11 to 12% zone. We go to next slide. Recently, the corporate earnings growth has picked up after a long period of lull. As you saw in the slide we just shared in the previous to this one, and as you can see in the lower left hand side slide, last many years have been fairly mediocre earnings growth. From FY11 to FY20, we've not had a single double-digit growth, but FY21 was, after FY11, the first year of mid-teens growth, and that earnings growth is expected to accelerate further this year. Remains to be seen whether we get the projected 30%. Quite likely that 30% projection would need to be scaled down by the consensus, but still believe that 20 odd percent earnings growth year over year is deliverable on the back of several factors, including some of the ones that are listed here. There has been market share consolidation over the last 18 months in favor of larger players in every industry, which tend to be, obviously, when I say larger, it does not mean the largest Nifty 50 players or anything. It's just that in every industry, the mom and pops and the unorganized sector has struggled more over the last 18 months due to supply chain disruptions. And as a result, the organized players, which is what listed companies tend to be for most part, they have gained market share. As we'll share some examples on the next slide that would further elaborate on this point. Secondly, just as you had supply chain disruptions in India, you had supply chain disruptions globally as well. As many of you on the call today, you run your own businesses and otherwise, have interactions with what's going on around the world in terms of import export. Because of the supply chain disruptions, raw material prices and raw material availability has been a key shortage area. And there too, recognizing the risk, or I shouldn't say recognizing, the risk of being overly dependent on one country in the supply chain has further come to the forefront, and people, companies, corporates around the world, the leading corporates around the world, they want to further accelerate the diversification of supply chain from what has been overly dependent on China. Now, this is not something new. It has been going on for many years, but this trend picked up pace after Donald Trump, highlighted the not just highlighted the risks, but introduced several tariff barriers and really escalated the pitch against China and asked corporates in America to find alternative sources. So it's been going on, and post the pandemic, that risk has further been escalated. And so a lot of corporates in India across manufacturing industries in particular have been benefiting from that diversification of supply chain away from China. There's also been certain sectoral specific developments that have helped this corporate earnings growth. First and foremost, I would highlight the technology, IT services segment. So overall tech spend around the world have accelerated after pandemic. I'm sure you all have heard in the media, and these CEOs of leading corporates, not only in India but around the world, have noted that what would have been a gradual adoption of new age technologies over the next decade has been accelerated in a compressed time frame in 3 to 5 years. And Indian IT services companies are right at the heart of it in helping corporates globally, enterprises globally to make this transition and are benefiting from very strong growth of the kind that has not been seen at least in the last decade or even 2 decades. So their IT spending driven jump in the tech sector corporate earnings is very visible. And remember, IT services sector is the second largest sector in India, so it's not a small sector we're talking about. Besides this, obviously, the smaller sectors like commodities, which have benefited uh, due to the surge in commodity prices globally. While the sector is small, the rapid rise in the sharp surge in prices in global commodities has helped the corporate earnings to multiply in this sector. And also real estate, while again a small sector in the index, but there are several spillover effects into consumer durables and home appliances and other building materials and related industries, which are benefiting from the surge in real estate demand, particularly residential demand, which again is stronger than what it has been in at least a decade. So these are some of the factors that have supported the strong earnings growth and are expected to going forward as well. Just the first one, which I wanted to elaborate a little bit more, is the consolidation of market share in favor of the larger players. I hope you're able to see this on your screen, but even if you're not, I'll just read out. Let's take an example that we all can relate to: jewelry sector. So Titan reported just a week ago or so its numbers, and the 2 year CAGR, because year over year numbers are distorted. Last year was impacted by COVID. This year is impacted in different ways by COVID. But if you look at a 2 year number, compounded growth was in the high 20s, some 27, 28% compounded top line, if I'm not mistaken. Certainly, the jewelry industry has not grown at that pace. The industry might have barely grown low single digit percent or so. So what has helped Titan grow that much faster is the market share gain from mom and pops. A lot of the customers, clients, been hesitant to go into a small mom and pop store, and instead during this pandemic time find the large well organized stores of Titan, which are thousands of square feet, to be a more a safer and hygienic environment to do the shopping. Also, large players like Titan have uh, leveraged the omni-channel mode of delivery and retailing far more effectively than small mom and pop players. So they've adopted the technology to showcase their jewelry while customers are at home. So instead of a customer having to come to a store and try on 50 or let's say a few dozen different types of designs, they can do the pre-selection online and then can just pick the right one from the store or can be delivered the right one to their home. So that's just one example, but across board in various industries, we've seen that the larger organized player have adapted themselves, evolved in a much better manner during this pandemic to adopt the technology, omni-channel delivery mechanisms, and gain market share from the unorganized sector. We go to the next slide, and then I would turn it over to Ramesh. I also want to highlight an important development, which we've been waiting for a long time to see as a real indicator of the government's reform agenda has been privatization. In the prior conversations, also, I'm sure we have talked about it. And in our fact sheets, newsletters, which I hope you do take time to read, we have mentioned that what investors globally would be keenly watching for, and we are keenly watching for, is the progress that the government makes on privatization. And there it is very heartening to see, very encouraging to see the Air India privatization finally going through, or seems like has finally is going through, with at least the bidder Tatas having been selected in a very fair and transparent mechanism. Hopefully, this is first of many such to come. I think that's one of the biggest inefficiencies that has persisted in the Indian economy for much longer than it ought to. And the government has already selected a long list of PSUs for strategic divestments or outright privatizations, basically. We are very keen to see that following Air India, that process gains momentum. And if it does, that would be the biggest positive for the market, and one of the biggest reform items that this government would be implementing. With that, I'm going to pause and look forward to answering some of your questions at the tail end, and turn it over to Ramesh for going over the portfolio and performance over the last few months.
Yeah, thank you, Prashant, and good evening to all the participants joining this call. And I hope you're all well. First, talking about our performance, this year, our performance has kept up with the market. This has been, of course, a strong year for the markets. And one of the key characteristics of the market this year has been the strong outperformance of mid caps and small caps over large caps, which is something we had only seen earlier in 2017. So that's been the distinctive feature of the market. There are other features about the market that I would talk to you about in the attribution analysis for the first 9 months of this year. Now, this is our attribution analysis of our performance by industry sectors. While there's a lot of data on this slide, I'll focus on some of the key elements here. While any attribution analysis of a 9-month is a short period to draw any conclusive evidence of a manager's capability, but we thought we'll still highlight what happened in the last 9 months from our portfolio perspective. So as you can see, the portfolio returned 35% returns, the benchmark returned 32%, and a gross alpha of 3.2% was delivered over the 9 months. When you decompose this attribution, 5.3% returns came through stock selection effect, and -2 came through allocation effect. Allocation effect is the effect of either having higher or lower exposure to a particular industry sector during the period, while stock selection is about generating returns through stock picking in various industry sectors. As you can see, even over this period, more than 100% of our alpha has come through stock selection, which is a skill-based factor and should give you a lot of confidence in the investment team and our process. If you go more into what happened to the market during this period, if you think about the market this year has been a strongly pro-cyclical. Sectors have done exceedingly well this year. So the best performing sector in the market this year has been metals. Steel and aluminum are up 85%, when the market itself has delivered 32% return. Then the other best performing sectors are utilities, which largely comprises of PSUs, and then industrials. So these have been the best performing industry sectors. So all the best performing sectors tend to come from a pro-cyclical sectors of the market. If you think about the previous year, 2020, the first half, because of the first phase of the pandemic, the defensive sectors outperformed the market. And in the second half, the pro-cyclical sectors outperformed. And over a year, it was a lot more balanced market. But this year is a strongly pro-cyclical market. And what happened? So what are the weakest sectors this year? It's pharma, it's consumer staples, consumer discretionary, and financials. These are the weakest sectors in the market. When you think about how we structure our portfolio, and something that we have discussed a lot in our previous calls, is we always run balanced portfolios where we have a good balance between defensive sectors like consumer, pharma, technology in our portfolio, and then pro-cyclical sectors like financials, industrials, materials, real estate. This is one year where only the pro-cyclical elements part of the market have done exceedingly well. And because we run balanced portfolios, this has been a headwind to our portfolios. Yet, because the stock selection has been still strong over this period, we have been still able to prevent this headwind from creating a drag on our portfolio returns. And if you look at the composition of alpha, of course, technology has generated the highest alpha. Our biggest drag actually was our metals. And since we have earlier spoken, many times, metals is a global, macro sector. Large part of the fortunes of the metal sector gets determined by what the Chinese government does. So, and we don't have an additional edge on understanding what the Chinese government does. So that's actually been the sector that caused a lot of the drag in our allocation in our portfolio. Otherwise, our performance across sectors have been strong. The better way, I would say, is to look, and now we can talk about what stocks have, what are the top 10 contributors and detractors, which will again give a little more color on what happened in the first 9 months. Obviously, in a short period, whichever sector does well in the market, the biggest contributors will come from that sector. So in our portfolio, because technology has been the largest alpha generator, 5 out of the 10 names are from technology. But the interesting part is financials, which has been one of the weakest sectors. We in fact have top 2 contributors even coming from financials, which are Bajaj Finance, Finserv, and CAMS. That shows the ability of our stock picking. And then you have a number of stocks that come from various diverse sectors, including industrials and including stocks from healthcare. Then again proves our stock picking ability. In terms of detractors, most of the detractors are coming from consumer, the top detractors, simply because consumer has been a weaker performing part of the market for short term. And of course, financials and pharma, again, these sectors have underperformed over the short period. And it's natural that detractors over a short period come from those sectors. However, when you look at this attribution analysis from a longer period, you get a very different picture, and actually you get a much truer sense of what our capabilities and our skills are. So if you look at first, we can even also go to the previous slide on this. First, market cap attribution, over the last 2.5 years, which is slightly a better period to judge any manager's capability. As you can see, the alpha has been 38%, the bottom right corner, and the stock selection accounts for 46% of the returns, and allocation effect is -7. And we have delivered strong stock selection effect in each of the market cap bucket over the last 2.5 years of the Pioneer strategy. Moving on to the sector attribution. Again, over this period, out of the 38% returns, allocation effect accounts for less than 5% of the returns, and 36% of the returns have come through stock selection. Stock selection is positive in all industry sectors in the last 2.5 years. That showcases our ability of the investment team at White Oak to pick the best stocks across every industry sector. And finally, looking at the top 10 contributors and detractors over the last 2.5 years, you'll of course see a very different picture. The top 10 contributors come from a variety of industry sectors, from consumer, chemicals, pharma, financials, healthcare, industrials. That again showcases the diversity of our ability to pick stocks across industry sectors. So finally, looking at how our portfolio is positioned in the next slide. So as you can see, this slide shows the portfolio, different characteristics of our portfolio. We have 53 stocks, in our portfolio, and we have explained previously many times why we believe managing diversified portfolio is a better strategy to deliver alpha in the Indian market. In terms of our key characteristics of our portfolio, including our favorite metrics, the OPCO FinCo valuation metric, our portfolio is more attractive than the market, despite the fact that we don't own the companies with poor corporate governance, which are part of the index in our portfolio. In terms of market cap attribution, 57% of the portfolio is in large cap, 42% in small cap. So we continue to invest in the best ideas in large caps, mid caps, and small caps as a flexi cap strategy. And finally, looking at industry sectors, as you can see, we are invested in broadly all major industry sectors in the market. Energy and utilities, it's not that top down we are negative about energy and utilities. It's just that, one, these sectors have, large number of PSU companies, and we don't have an edge to generate alpha in PSU companies. And PSU companies, and yesterday's experience shows that they may not all the time be, managed for the benefit of minority shareholders, right? The alignment of management is not so clear.